Hello, everyone. I'd like to invite all of you, to check out etfatlas.com. It's a brand new portal that offers a comprehensive catalog of ETFs from the United States, Canada, and Europe. And whether you're a seasoned investor or just starting out, etfatlas.com is an invaluable resource for researching and comparing ETFs. And as it's a new site, we'd be incredibly grateful for your feedback. And now let's start our discussion with our first guest of this show, Paul Merriman. Hello, Paul.
Jack, how are you?
I'm fine, thank you. How about you?
I'm just doing great. I feel that recently I have been attacked many times on my advocacy of small cap value. And I'm just hoping that somewhere along this discussion that you'll give us a chance to talk a little bit about that, because it's consuming a lot of my life.
Yes, so for sure we will discuss small cap value as well. But before doing that, let's start from the beginning. Your journey in the world of investing is truly remarkable. Could you walk us through your background from your early days as a broker to founding your own advisory firm and then eventually establishing the Merriman Financial Education Foundation? What were the pivotal moments that shaped your investment philosophy, Paul?
I was thinking about that recently. I got married at 19. I was not a natural investor. I was a natural saver. I started working when I was 11 and worked all the way through junior high and high school. And so saving money, making money, I knew how to do that. But I didn't have any background in investing. And at 19, I get married. And my wife's father, an engineer, was in love with the stock market. He really enjoyed the stock market. And as I think about it, in a sense, that's where my investing story starts. He not only taught me how to understand investing, he taught me how to read a racing form through the eyes of an engineer. He taught me how to drink vodka martinis. After all, he was from Ukraine. But the point is, I think that was the first mentor that I had. And then when I went away to college, being married and all, I was having to work while I was going to school. So there wasn't a lot of time for investing. But I did come to the conclusion that what I wanted to be when I graduated was a stockbroker. And of course, I really had no idea what it meant to be a stockbroker, but that's what I wanted. And so I started when I was about 19, interviewing with a New York Stock Exchange company with the idea that I would go to work for them when I got out of college. And they kind of brushed me off and said, "Go away, young fellow, go out and learn how to sell anything, sell fuller brushes. But we don't want to hire young people." And I was talking about when I would be 21. And we want people who have sales experience, because that's the most important experience that you need. Now, I should have understood something from that guidance about the industry. But I did finally, after going back and bugging those people year after year. When I graduated, they hired me. And so I was in hog heaven. I just loved the fact that I was getting an opportunity to be part of the Wall Street experience. And of course, the Wall Street experience was to pick up a phone and call somebody and make a solicitation. So I did learn early on that there are conflicts of interest at that end of the industry that are huge. And the story I've shared many times was from a really nice guy. Ed was in his 30s. He was a smart guy. He helped his clients. But he told me when I came into the firm, we are not here to make money for our clients. We are here to become a member of the family, so beloved that to kick us out of the family would be as difficult as kicking one of the kids out of the family. So I learned again something about the industry that was kind of a red flag. But within a couple of years, I saw the light and I got out of the industry, that part of the industry. And then I did a whole bunch of different things. I started a mail order company. I ran a manufacturing company, a small local public company in the Seattle area. I did things that didn't exactly have to do with Wall Street, but they were on the edges, certainly, of Wall Street. And then finally, I had this amazing thing happen. I was not part of an organized FI community. Nobody knew the idea of financial independence and retiring early, but I had enough at age 40 to, in essence, retire. Now, as anybody who's ever lived with a workaholics never retire. I mean, they just keep moving and they keep getting up early in the morning. And I mean, it's just the nature of the beast. And so, what I did when I felt that I had reached my phi number was that I decided to start an investment advisory company and that I was going to help a few hundred people. I did not, I saw what I was doing to myself. I saw that I was out of control and that I was putting in way too many hours and that it wasn't good for the family. And it probably wasn't even good for my health, but that's what I'd been doing. So I started this thing for fun, purely for fun. And my minimum amount of money to hire me, you had to have $2,000. If you had $2,000, I was the guy that would go to work for you for a year and charge you 1% or $20 to give you the financial advice. Well, I might not have been a great advisor at that point. In fact, I never became a certified financial planner, Jack. We had lots of people in the firm that did that by the time that the firm had matured 30 years later. But at that point, I was giving financial advice and in essence, not actually educated to do that. But what I could do is I could give investment advice. There was nothing illegal about that, or nor was it misleading to people. I will say this, that I made one of the typical mistakes that investors make. And that is we have a tendency to gravitate towards what has been doing best lately. Now, lately may be the last year, it could be the last 5 years. But even if you looked at the last 20 years, it could still be chasing performance. And so when I started that investment advisory firm in 1983, I looked back over the previous 20 years and what had worked. Buy and hold? No way. Buy and hold was a failure. Buy and hold meant you started whatever you started with 20 years earlier, you still had about the same amount of money. You literally had gone up and down and up and down, and you hadn't gotten anywhere. But there was a way. And that way, over that 20-year period, was to use simple market timing strategies to be able to time the market. And I don't mean accurately. I don't mean getting in at the bottom, getting out at the top. I mean using traditional kinds of trend following strategies that you do what the system says. When the trend changes from up to down, you get out, you go to a money market fund, and when it then goes back up, you get back in and you put your money back into the mutual fund. And it was, to me, it was simple and theoretically something anybody could do. Well, it turned out that the worst strategy you could use after that 20-year whipsawing back and forth was market timing. You were way better off to be a buy and holder for the next 20 years. And yet I built a bunch of clients, and all of a sudden it was not a $2,000 minimum. It was a $100,000 minimum. And that's only because I couldn't do all the work that was there. And if I was going to hire people to do it, then they had to do it with enough that it would pay to have them on the payroll. I mean, it's the problems that we like to have as an entrepreneur. But what happened was, after about 10 years of market timing, and I think we had $400 million under management, my son, my mentor at that time, came to me and he said, "Dad, there are a lot of our clients, they like what we're doing, but I think we should consider adding buy and hold to the strategy as well as market timing." So I suspect we were the first market timer that also advocated for buy and hold, which confused people. They would come to my free 3 and 6 hour workshops. And at the end of the workshop, when I've taught them how to be a good buy and holder and how to be a good market timer, they would walk out of there and ask, what does this guy really believe in? Well, I guess it is confusing. And one of the lessons that I learned, particularly after having built my business and sold the business in 2012, I realized I do not want to try to help do-it-yourself investors be market timers, because they're not going to do it. The odds of somebody, and you know this, I think, too, Jack, because you understand market timing, you have to do so many things that are counterintuitive that you just basically give up and say there's got to be an easier way. And so that easier way theoretically is to be a buy and holder. And guess what? That's not easy either, because people still have a desire to have their money in what's been doing well lately rather than having a broadly diversified portfolio that gives you exposure to good stuff and bad. I mean, that's the whole idea of diversification. You're going to be unhappy with part of the portfolio. But when I sold the company and I took part of the money I got for selling the company and I started the foundation with a commitment to my wife, one, I will never work for money again, and I haven't. I don't take any money for the work that I do. All of the money, if there's any income that comes to me or the foundation, it goes to the foundation, not to me. And so I am now 100% teacher, 0% investment advisor. And so now my job is to think through the eyes of an individual. How do we manage money that we have the highest probability of staying the course for the long term? And I know that's not easy. And I know I only have a limited number of years I can keep doing what I'm doing now. But my hope is that we'll leave enough of an imprint that there will be people long after I'm gone that will be doing the work that we are recommending today.
The Merriman Financial Education Foundation, which you mentioned about, has a unique mission. How does it differ from other initiatives, like, for example, the Bogleheads movement? Is it maybe fair to say that at some day we will talk about Merriman heads as we are talking about Bogleheads? So maybe in the future we will be talking about Merriman heads. I don't know what's your view on that, but what specific gaps in financial education are you aiming to address with your foundation?
Well, I don't think there'll ever be a Merriman heads because that implies a big brain. Jack Bogle had a big brain. I don't have a big brain, Jack. I have a normal brain that happens to know a lot about a few things regarding investing that I think are really the most important things that people need to understand. And what is different about our work? Our work is aimed at taking the investor up to a fork in the road, stocks versus bonds. What is the evidence? There is a reason why probably 90% of the people who follow our work are either engineers or other people who work in areas where evidence based decision making is an important thing to do, not just the latest great sales pitch. So we take you up to that decision, stocks versus bonds, and we want to make the case for both of them. It isn't that we say bonds are bad, but when we learned that $100 in bonds grew to $12,000 over almost 100 years, and $100 in the S&P 500 grew to almost $1 million over the same period of time, I think it's something a young person should sit up and take notice about in their decision-making process. So we are really trying to be more forceful and take over more. In a way, we're making decisions for people, but then we're advocating for those decisions and telling you why we believe what we believe. So if we get you past the stocks versus bonds decision, then you might want to know, okay, there are tens of thousands of stocks out there to buy. How do I know which ones to buy? And it turns out the academic community has taught us that it's not about which ones you want to buy. It's about what asset classes, I'm talking equity asset classes, you want to hold in your portfolio. So we introduce you to the 10 that I was introduced to in 1993 or 94 by the people at Dimensional Funds and the work of Dr. Eugene Fama and Kenneth French. And so all I have done is walk people through the implications of owning those 10 equity asset classes. And every year we update the returns of the implications of having those 10 in your portfolio. But as we found out, particularly for do-it-yourselfers, you come to another fork in the road. And that is, okay, let's say there are 10 equity asset classes that the academics have put their stamp of approval on. How much should you put in each one? And so we have created portfolios and show you year by year returns of portfolios that are only 50-50 S&P 500 and small cap value, or one that's a combination of large cap U.S., small cap value U.S., and international large cap value and international small cap blend. We have 9 different portfolios for you to choose from. And if you choose from them in your all equity portfolio, and we give you tons of data as to why you might pick one over another. So not everybody comes to the same decision. And that's why we have the several of them, more than a handful. But then you got this big decision as you get older. All right, now equities are fine, but I don't have the risk tolerance to lose over half of my money anymore. So the question is, how much in bonds? Well, if we're going to help you with that, we have to give you the numbers, how much in bonds and how much in stocks. And so we have tables that show you the year by year returns of these different combinations and the worst periods and the worst drawdown and the compound rate of return. And then we show you the distribution strategies. In other words, we are walking you through step by step these approximately 9 or 10 decisions. And at the end of the day, which I don't know anybody else that does it like we do, we know that most of you are not going to sit down and whether they use your database, Jack, or somebody else's, and compare all these different ETFs or mutual funds to figure out, okay, I've decided to take Merriman's portfolio that has me 25% in small cap value. But I don't know what small cap value ETF to put in my portfolio. We know that that's going to be the way a lot of people feel. So we tell you, we've done the homework. We cannot see the future. Nobody can see the future, but we can pick out like small cap value ETFs that have the highest probability of giving the highest return. And there's tons of evidence. You know the evidence. I know the evidence. But Jack, we love this evidence. We really enjoy spending time with numbers. Some people like to spend time with people. Some of us like to spend time with numbers. But the bottom line is we have now walked the investor through everything so that they can, on a do-it-yourself basis, they can put the portfolio together and eliminate having to hire an investment advisor to do that for them and putting an extra 1% in their pocket for the rest of their life. Now, I know that I made a living off of people who didn't want to be do-it-yourselfers. And if people don't want to be do-it-yourselfers, then they need to get help. But you know something, even then, if you want help that takes care of you professionally, why not look at a robo-advised portfolio or a target date fund? They're basically the same thing. And have somebody who will do that for you for the rest of your life for basically nothing other than the very low cost of managing the funds themselves. So we are different in that regard. Most people, newsletter writers, do not try to take people deep into these decisions. And the reason that I believe in taking people deep is because that is the best probability that they are going to be able to stay the course. And I'm sorry to go on and on about this, but I think it's important that when we're trying to help people and we want to do the whole job, then you've got to dig deep and you've got to show them the same information that the investment advisor would need to know, because when you're a do-it-yourself investor, you are the advisor for the number one investor in the world. And I want you to be prepared to do that.
Paul, I wanted to ask you about John Bogle. Your 2017 meeting with John Bogle seems to have been a significant event, and you mentioned it changed your perspective on Bogle and on Vanguard as such, and also that Bogle was very nice to you except for 30 seconds. Could you share more about this encounter and what insights did you gain and what happened during those intriguing 30 seconds with John Bogle?
Well, I will tell you this. He had more arthritis than I have in my hand. And by golly, when he waggled his finger at me for 30 seconds and made a short speech, boy, I'll tell you, I listened. No, it was a fascinating 90 minutes. And if my wife had not just kept telling me, go back and see him. He's invited you to meet with him. Go back and see him. And I'm real frugal. The idea of spending money to go back and sit with him just was difficult, but I did it. And boy, did I get a payoff. And what I found out, a couple of things that are important to know about what we believe in versus what Jack Bogle believed in. He had a goal for each and every investor. And by the way, when I spoke with him, he didn't have anything to say about the institutional end of the business. The only end of the business he seemed to care about was the end that addressed the small investor and the person who, if they didn't do the right things, if they listened to Wall Street, would likely not be able to retire with the amount of money that they would have if they listened to Jack Bogle and if they used index funds and all of the things that we now know about, but certainly were not common knowledge back in fact, even in 1983 when I started my investment management company, Vanguard was not established as the king of the hill as it was by about 1999. But here is his focus. His focus was having people do the right thing and to have them do it for a lifetime. And if they would, he believed they would have enough money to retire. And I totally get it. I didn't realize how attached to it he was until I had that time with him, but I do get it. I, on the other hand, legitimately have a more aggressive wish for the people that we're serving. I really want people to shoot for more than they need. I want people to have a lot of money left over at the end of their life, not because of greed or not because of the what you can buy with money so much as how many times in our lives did we make a wish and set out with some plans that when in fact we got into the thick of it and found out what life was really like, that things didn't turn out to be the same and that we would have been better off if we would have set our sights a little higher in the beginning so that when we failed to get what we thought we were going to get, that we'd have enough. So my belief is if we shoot for more than enough and we end up with enough, that's enough. That's good. On the other hand, if what you do is you count on things being good, we should never forget this, that in 1999 and early 2000, there were surveys where people were asked, what return do you think the S&P 500 will have over the next decade? And the averages ran 20 to 30%. What crazy person would believe that the next 10 years they should be entitled to a 20 to 30% return? Well, the reason they believe that is because for the previous 5 years, the S&P 500 had compounded at 28.5%. And so only making 20% ought to be a piece of cake. Well, okay, what's really happened? Over the last 25 years, the S&P 500 has compounded at 7.9%. What happened to that, even the 10% that we all knew was baked into the S&P 500? We think that's what we're entitled to. Well, we're not entitled to anything, and we can never know where the market is going to be at the time that we finally retire. I mean, we could retire and the next year the market goes down 50%. The market owes us nothing. And so what I believe is we do what we can to protect ourselves against the catastrophic. I worked longer than I had to because I wanted to accumulate several times what I needed, because I have always been one of those, the glass is half empty. I've always been afraid of the catastrophic ever since I was a kid. And so I think, by the way, this idea of over saving, that's going to appeal to a lot of people. I know from experience, but a lot of other people want to die broke. And we, of course, we know how to do that too. But the bottom line is the difference between Jack Bogle and me. One is, well, actually, there's another one, but one is the fact that I want you to have more than enough. And the other is Jack Bogle, the waggling of the finger, was about him being critical of me trying to teach people, because that's what I was doing in 2017. I was still teaching people how to build a 10 fund portfolio. He said, you can't do that to people. They won't do it. They won't stay the course. There'll be too many reasons why they should monkey with the portfolio. He said, I think the work that Fama and French have done is great work, but people shouldn't try to use it because it will confuse them. And I know he's right. So what have I decided to do? By God, I'm going to educate a handful of people, even if they're all engineers, so be it. We know that engineers as a group are good savers. We know that engineers as a group tend to be frugal. And so I know I'm preaching to a choir of people that have some of the same beliefs that I do, or we do. And in fact, Chris Pedersen and Daryl Balls, the two guys that I work with and are trying to help folks, they're both engineers. I have a 60 plus year history as a salesperson. So I just happen to believe as a salesperson what the engineers and the academics have taught me.
Paul, let's consider then a complete novice to investing, and let's imagine such person. And how would you approach convincing someone to think about their financial future and how to start investing? And once they on board, so that you have convinced them to invest, what specific strategy would you recommend for long-term capital building, particularly for retirement? How does this strategy differ maybe from, let's say, conventional wisdom?
Well, I don't know how different I will be from conventional wisdom, but I do know that what I'm trying to teach young people is that this is not about what's a stock and what's a bond. And a lot of these things that lead people to building portfolios. I start them at the base. I start them with the impact of math on numbers, the impact of compounding on numbers, the impact of compounding early, doesn't matter about the stock market or the bond market. It's just, what is the math of investing? And if they don't understand that, I fear that they won't have the ability to stay the course if they don't understand that it is about the math. How you reach those numbers that you talk about in the math of investing is about choosing either bonds or stocks. And we get around to that later. But I do believe, and this is something that has taken me a long time to put together, I do believe that for these, like the college kids that I'm talking with, I want them to realize that investing is simply a series of real easy steps that have to do with building a business. Because when we invest, we are in business, and we are the business. And we are the ones who have the $10 a month or $100 a month or $1,000 a month to put into the business. And that the future success of this business is not about the market. The future success is all built on your ability as the senior partner into this relationship with the other parts of your business. But you are the senior partner because at the end of the first year, you put in $1,000. It is now worth $1,050 because the market went up a little bit. And so what was your success about in your first year of business? Because you put the money in there to start it. The market made a lousy $50, and it wasn't easy for you to come up with 1,000 in the first place. But that's the start of building this business. And this business is, as far as I'm concerned, is the best business in the world. It's the business of whether it's 500 companies in the S&P 500 or 1,000 companies in a portfolio that's half in the S&P 500 and half in small cap value. I don't care what that arrangement is, but I do know this, that when you get up in the morning, those businesses, many of them have been working all night. People have been getting up, going for their 8 hour period, and they got their lunchbox with them, and they're working hard. And also people working for those companies that you own, they're crooks. They're just outright crooks. They're liars and they're cheats, but they're in there. We got to understand that. And so some of the people that work for you are in China. Some of the people are in Japan. Even if you only think you're in the U.S., I can tell you, you got money working, people working for you overseas. You got a business that's cooking and likely to continue to move along. As a matter of fact, a great deal higher probability than if you went out and started a business on your own today. I would bet on the S&P 500, and I would probably over an individual starting the business, because we know that's, I don't know, 1 out of 10 or 1 out of 15 businesses survive. No, our business is going to survive. How well it will do will be based on things that I have no control over. But you're building that business. Then a magic day comes. It is truly magic. Or let's call it a magic year. And in that magic year, you look at what the investments made for you, and they've made you 100,000 in this last year because you started with 1,000. And we show tables, lots of tables, exactly how this would have happened since 1970. In fact, we even have a calculator that you can go back and start in 1983, or you could start in 1990, and you could see how you would have done. But the bottom line is, at that point, that your businesses are paying you more than you're putting in. Now we've got a partnership that I like, because I'm hoping you will have learned the lesson to keep putting in the relatively small amount of money you're putting in, but ride the wave of long-term success of this multitude of investments. And the academics have taught us something really important, Jack, and that is the likelihood of long-term success as an investor is better if you own all the companies than if you own the companies you think are the best. I just went back and looked at 1999. What were the 7? I know we talk about the magic 7 or whatever we have right now in our economy, but there were the 7 biggest companies back in end of 1999. Those 7 companies have produced about half the return of the S&P 500 since then. And one of those 7 went through bankruptcy and is now worth a tenth of what it was in 1999. And so I want people to be business-like. And if you're business-like, would you want to pay the highest possible expenses that you could? No, I don't think so. I mean, we wanted to pay people fairly, but if we pay people unfairly, then we earn something that's unfair. So a good business person would make the decision probably to buy a low-cost fund. They wouldn't pay a low to get in. And from everything we know about active management, they wouldn't want to invest in an actively managed fund because there's a probability, yes, that 1 in 10 will do as well or better than the index, but the other 9 are going to be less, and some of those will make as much less as 2% a year. Well, 2% a year is a big deal. So I want people to understand the math and then understand how to act like an intelligent business person in building this amazing portfolio. Here I am at 81. I don't need to tell you that I've got more than $1 million because that's what I put into our foundation to get it started. What I have is a good sized little business. And I have friends who are in business whose businesses are no bigger than my business. So I take it seriously. I know every question, Jack, the answers are too long, but
That's wonderful. Thank you for that. We could talk and talk. I remember our last conversation. It was probably the longest interview with you whoever made.
It was 2 hours.
Yes. So I know you even split it into two parts. But I have still plenty of questions for our today's conversation. And I wanted to ask you, how do you view the trade-offs between complexity and simplicity in portfolio construction, especially for long-term investors?
Well, I think the big complexity question is, will you maintain it? I know this. I know that a four-fund portfolio, and we have an absolutely wonderful quilt chart that shows this. When I look at the quilt chart, what I see is the annual return of four different equity asset classes. One is large cap blend, one is large cap value, one is small cap blend, and small cap value. And we look also at a portfolio that was 25% in each of those four equity asset classes. Now, I know we can't expect the future to be the same. Although I have a different opinion of that. I think the future will look just like the past, except for one thing. But here's what I know. I know that if you took that four fund strategy and you rebalanced once a year back to even amounts, that you would, over the last 96 years, have about 1.8% compound rate of return. Another person in the industry, he looked at it, he said 1.7. I'm fine. I'm fine with either one. Because the S&P 500 on its own compounded at about 10. And so what does that suggest? It suggests that if you were willing to buy four funds instead of one, and if you're willing to rebalance once a year instead of just don't worry about it, just keep on trucking, that you would get a very fine return with the S&P 500. But I can tell you this, about 28% of the time you'd be at the top, and 41% of the time you'd be at the bottom of those five different choices, all over the place. And the quilt chart colors each asset class so you can follow the S&P 500 up and down and all over the place, just as easy as pie. Now, what do I like about that? I like the fact that the four fund strategy has much less volatility year to year and has never been at the top and never been at the bottom. I don't care if I've never been at the top or at the bottom. That is not my goal in life. My goal in life is to get a good unit of return per unit of risk. So from my viewpoint, with the complexity of having four funds instead of one, rebalancing once a year, this is not complex. But I can tell you a lot of people, because I've talked to these people, Jack, they said, I don't know how to do all this stuff. This is way beyond me. I need somebody else to do it. Well, when you follow the math of paying somebody 1% to do it for a lifetime, and you put away $6,000 a year for 40 years, and then you live on it, and then you die at age 95, you will have paid out, because of that 1% charge, $3.5 million in management fees. would it be worth $3.5 billion for a 21-year-old or a 30-year-old or even a 60-year-old to keep that 1% in your family's pocket rather than somebody else's? And again, I did this for people who wouldn't do it on their own. But I always showed them how to do it on their own. If they wanted to, go at it. And I've always had a certain appreciation of their dilemma. And what I have used for 40 years in my presentations is I tell people that I've been on a diet virtually since the 5th grade. I have lost over 4,000 pounds. And that's because I have no idea how to maintain the discipline. Obviously I can't understand how to do it. Do I read about how to do it? Do I watch about how to do it or listen? Yeah, of course. But then I get in there and oh my God, it's such an emotional thing. Well, so is your money.
Simple, but not easy.
That's right. That's right.
Paul, I wanted to talk about small cap value. That's always, whenever there's some interview with you, the topic which appears. And your data-driven approach to investing is well known, let's say, even in industry, and the advocacy for small cap value. And as Edwards Deming, for example, famously stated, without data, you're just another person with an opinion. Yeah. Could you elaborate on why this particular asset class is so compelling to you? I mean, small cap value. And how do you reconcile historical data with future expectations? In what ways do you believe that a rigorous analysis of data can help investors identify opportunities in small cap value? And how do you address potential criticism, because there's a lot of criticism also regarding the reliance on historical performance as a predictor of future results? Sorry for the very long question.
It is the challenge, I think, that investors have with whatever decisions they make. Because we have the same problems for people with internationals and REITs and anything that hasn't been performing well lately. What I find interesting is if we have trust and confidence in the future of a particular equity asset class or a company, it could be a company, but if we have confidence, then we are more likely to stay the course. And so when I think about an example where people ought to be questioning, what are you doing? If we know that the S&P 500 for 25 years from 1975 to 1999 compounded at 17.2%, what do we do with the fact that for the last 25 years, it's compounded at 7.9? Well, wait a minute, I've been expecting for my long-term plan that the S&P 500 would compound at 10. Oh no, that premium's gone. Things have changed. Now, understand that small cap value has had some great years in the last 25, and it's had some bad years. Well, welcome to the club of the S&P 500. I mean, this is the nature of investing. But let me tell you why I feel so strongly, even to the extent that with my 2-year-old granddaughter, when my wife and I put away $10,000 to start when she is old enough and is working and is making something, I want this $10,000 to be used, and whatever it grows to be used to fund a Roth IRA for however long it lasts. And that money is split half in a total market index, not the Vanguard, not the Fidelity, but a different one that I think will do better. And the other is in small cap value. And at age 18, when she receives the letter from her grandmother and grandfather that will be waiting for her to get to 18, because I'm not likely to be around in 18 years. and a video that she'll have of a much younger grandfather than she might know in these years now. And I want her to look and see, how did the S&P 500 hold up year to year? Well, let me tell you, you can say that 18 years doesn't matter. But I also know that over the last 96 years, the compound rate of return of the small cap value index, according to the academics, is over 13%. And the S&P 500 is about 10. So do I think there will be a premium for small cap value in the future? Yes. Or investing will have stopped working the way that investing is understood. Because if small cap value can fail, so can the S&P 500 fail to out earn the the bond market. Could be that bonds are going to be better than the S&P 500. They have been several times better for 20-year periods since 1928. So it won't be the first time that stocks have underproduced bonds. So if that is the case, is there anything that has changed that today one would say, that happened then, but it's not going to happen again? Then I'd look, I've got a table here. I'll give you a link to it, but the table, it actually looks at year by year the results of small cap value versus the S&P 500. But here's all I want you to know, that when we put this table together, we looked at every year the returns for the S&P and small cap value. One of them did better than the other. Great, we call that a win. But I want to know by how much. So then we have a winner and a winner by, in 1970, the S&P 500 was the winner, and it beat small cap value by 5.4%. I know that. And I also know that from 1970 to 1979, there were 3 years the S&P 500 was the winner, and 7 that small cap value was. So now if I'm a stockbroker and I like to sell performance, I'm out there pumping out the small cap value. It's where you should be for the future. That's what we look for to make a sales pitch, is recent performance. But then the next decade, the S&P 500 wins in 6 out of the 10. And then the next decade, 7 out of the 10 small S&P 500 wins. So we've got 20 years that the S&P 500 is crushing small cap value. And you want to go back in 1999 and 2000 and look at the articles that said small cap premium is dead. But then what happened next? From 2000 to 2009, 9 years small cap value beats S&P 500. Followed by 10 years that the S&P 500 wins in 6 of the years, and small cap value in 4. And so far, the 5 years of this decade, it's 3-2 in favor of the S&P 500. Give me any reason when I can look back to 1928 and see that there's been this premium and all of this. I mean, we can always cherry pick stuff. And what people need to understand, and we show them a telltale chart that goes back to 1928. And it shows that about 80% of the time, small cap value is just kind of holding in there with the S&P 500, not making any premium. And then, bam, it breaks out for a relatively short period of time. And what makes me so sad is I know that in those breakouts, when it has 4 or 5 years and it's just doing amazing, that people are going to rush into it. This is a good place to be. Just in time, I guess we could call it just in time bad investing. you have a period that it doesn't perform well, and then people give up.
Actually, I would like to make a step further. So we discussed small cap value, but I wanted to ask you about a bit different topic, but let's say related to it. Namely, the emergence of ETFs is providing us access to strategies, for example, like managed futures. And it has democratized sophisticated investment approaches. So I'm particularly interested in trend following strategies. So doing it on our own is not easy, but now we can just buy ETF doing what hedge funds were doing in the past. And research suggests, so I'm also a data-driven person as you are, suggests that incorporating trend following strategies into an equity portfolio can be especially compelling because they have the potential to reduce portfolio risk without sacrificing returns. Unlike bonds, I remember in one of your material, you were saying that bonds is like, pressing the brake pedal, that you are slowing down. And it doesn't have to be the case when you, instead of adding bonds, you are adding trend following managed futures. And I wanted to ask you about that new ETFs. They are just appearing since a few years, so it's still pretty new thing, especially for retail investors. But I even recall that you were using some trend following approach in your private portfolio. So
in my own portfolio, Jack, yes, I am partly in market timing. That works well for me and under the umbrella of an IRA or a tax deferred. And I have buy and hold, and my buy and hold is half U.S. and half international, and half big and half small, and half value and half blend. I mean, I got diversification, more diversification than I need, but because I'm a catastrophic person in terms of how I look at that glass, I feel comfortable having a huge amount of diversification. But here's why I am not an advocate of individuals' market timing. And this is not because I don't believe in market timing. I wouldn't have market timing in my own portfolio. And that is that market timing, and the first thing I think people need to understand is the unit of return per unit of risk is not going to change much with the timing. Because if you look at systems long enough and test them in good times and bad, what you'll find is a 70% equity, 30% fixed income strategy with timing will have about the same unit of return per unit of risk as a 50-50 buy and hold. So have you accomplished anything with the timing? Well, for me, you will have. I am not looking for higher rates of return. I am looking to reduce my volatility in my portfolio. And I know what it feels like to be out of the market when the market collapses. One of the lucky things that happened to me, and it only could be luck, is that in 1987, my trend following system, and all you'd have to do is apply any trend following system that was not too long term, got me out of the market about a month before the market collapsed. And so for the rest of that year, we were in cash. And I got on Wall Street Week, which was a TV show, and I got on Nightly Business Report, and I was a U.S. News and World Report, had a 3-page spread on me, my work, and boy, was that good for my business. But I can tell you that all the people who then hired me got to watch me have mediocre performance in 1988 because it was a different market pattern. And so I'm willing to be in equities with part of my portfolio with an exit strategy. And even then, I'm also market timing bonds in that portfolio. Not short-term bonds, obviously, but longer-term bonds and high-yield bonds. And international bond, but you can do a lot of different things. But I think Jack Bogle was right. If I try to help market timers, then it might actually end up convincing somebody that they should try to do it themselves. Now, I was your age. How old are you, Jack, if I may ask?
I'm 44 right now.
All right, 44. So I retired at age 40, and I remember how I felt about market timing. It was something everybody should have because it was trying to defend against the biggest risk of all at the end of the day that you can't otherwise diversify against is market risk. And so the only way to diversify for a buy and hold or to market risk is to have fixed income, which is why we have tables that show the implications of different percentages of bonds in a portfolio along with equities. But market timing means you have to have a strength, I'll call it of character or discipline. Maybe character is making it sound different than what it is. But if you can't accept multiple losing trades in a row, if you can't accept buying into a market that you got out of, but you're buying into it at a price higher than you got out of it, if you can't do that, you're not going to be a good market timer. And the market timer, this is not easy for people to put their head around. I am preparing for the very worst of times. I have got a way to manage a portion of my portfolio to address the catastrophic. A lot of people don't, they want to pretend that isn't going to be part of their life. It's like people who say that someday we have to pay the debt back and not keep piling up all this debt for future generations. And then we all clap and say, that's right, that's right. And it's going to start a couple generations from now. And it's the same thing with the kind of thing like the Depression. You can say, well, that'll never happen again. Well, yes, it probably will at some point. And in fact, what most people fail to realize is that from 1929 to 1938, the stock market return, yes, it was volatile, but at the end of that 10 years, you had a better return than from 2000 through 2009. We saw, in essence, the same thing again. And so I'm ready. And I hope that other people who have a sense that bad times are coming have the right amount of fixed income for whenever those bad times come. But I don't want young people preparing for the bad times except to celebrate every down day in the market because I want them to buy inexpensive shares. I just don't want to liquidate them to live on in my retirement.
All right. I think that the psychology is very important aspect of investing, and it's quite often underestimated. And how do you advise investors to maintain discipline during especially market downturns, as you mentioned? Because it's easy to say, I remember you said once that if there is a market downturn, to go to a shop and buy a good champagne because it's a great occasion to buy cheap stocks. But are there any cognitive biases you find particularly dangerous for long-term investors?
Well, I do think that the people who are sitting on all equity portfolios and they're retired, that in many cases, just to be fair, in many cases, those people have other income that, whether they're in stocks or bonds, it doesn't make any difference. But for people who it could make a difference, I think to overlook the possible downside in the market is a big mistake. Having said that, there are people who simply believe you are all equities all the time. And I'm actually working on an article and comparing 60-40 to all equities And it's amazing how often 60-40 beats the all equities. It's really, I find it very interesting. But anyway, I do think, and this is why we have these tables, that if you need a certain return, let's call it 6%, and that you need that in order to meet your needs with a 4% distribution and 2% growth for the future, that you should know what the risk is of making 6%. It's very likely that the risk that's built into that portfolio is a decline of 25 to 30% of the value of your portfolio. And if you don't have the willingness to address that as a reasonable downside, then it means you might likely have adjustments you'll be making. I have not given up on the idea that I could go live with my kids, but I'm not sure that they would want me with me talking on podcasts all the time. So it is that's always a possibility, is move in with the kids. But we're trying to, and John Bogle, he was trying to keep people from moving in with the kids. And so I think we need to be realistic about market returns. And one of the reasons that we have dozens and dozens and dozens of tables on distributions at 3%, at 4, at 5, at 6, fixed adjusted for inflation, variable with no inflation, and we have all these different ways for people to face the truth of the past. What we don't know is what the truth of the future will be. And I made a little comment earlier that I have a slightly different belief system than what most of the industry has regarding the past. I believe the future will, in essence, look like the past. I think we can count on that. And by that, I mean, last year, the S&P 500 was up, let's just call it 25%. And this year, and the year before that, it was a good year. But I can go back and look 1 year at a time at the returns of the S&P 500 between 1929, 28, and last year. And here's what I find out. There were lots of years that the market was up 25 to 30%. Lots of them. As a matter of fact, there were lots of years the market was up over 30. Oh, and then there was the downside. Some bad years, of course. Yes. I think we're going to have that in the future. Same good years, same bad years. What I don't think anybody can know, I know nobody can know, is what the sequence of returns is going to be. Nobody can know that. But to think that something different is going to happen in the future, we're going to have years that are all up under 10% or all up over 20, it's not going to happen. They're going to be all over the place forever. And if you don't get a sense of that, you look at those quilt charts, look at it 1 year at a time. Look at who number 1 and number 5 is. Look at how little they made so many years and how much they made others. This is a wild ride. And we have to look at it as a lifetime ride, not a year ride. I don't even know what I did last year. I have no idea what my personal value of my portfolio is versus the last of the year before. It doesn't matter. I've got 10 equity funds. I've got a handful of bond funds, and they're going to do what they're going to do. And I can't take any credit for having called the market was up. You watch what professionals do so often. They'll say, oh, I think the market's going to be up 10% next year. Well, yeah, I mean, that's the compound rate of return. As a matter of fact, I think it was actually only up exactly 10% one time. So their track record is not all that good either.
I wanted to ask you how might technological advancements or maybe demographic shifts or geopolitical factors influence investment strategies? Do you think that there is some risk, especially if we will look ahead decades, or do you think that people will just remain people and all these changes around us will just change the narration, but still our human behavior will stay the same?
I really believe the human behavior will be the same. I don't know. I think about you at age 40 some, and I think about what the world was like when I was 40 and started the business, technology, um, all the ways that we have to maintain discipline that we didn't have then. Their investing has never been easier. Investing has never been more efficient. It's never been lower cost. It's never been more tax efficient. This is it. I don't know what they can do to make it better, but they're going to. I just don't know what it is. But I do know this: for all the good information there is to help you and the ways to do it. I mean, now when you go into a 401k plan, they automatically enroll you. They automatically up the amount every year that you put into it. I mean, there are these ways that they have of taking better care of your money, because you tend not to take very good care of it yourself, particularly when you're young. But what we also have more than we need, and I mean by a factor of 10, is bad information, bad advice, things that are not in your best interest, things that do not have high probability of long-term success. Having said that, people will win lotteries. I know this is hard to believe, but at odds of 300 million to 1, people will still win lotteries. And yet, theoretically, you could see a world where the lottery gets to $10 billion, I guess. So I don't know what's going to happen. I do know that I trust low expenses. I trust low turnover. I trust broad diversification. I trust equity asset class diversification. The academics believe it. It's not just having 500 stocks that are all large company growth or mostly large company growth. It's about having other equity asset classes. For some, it's international. Don't need international. You can live without international. Your returns will be about the same with internationals, but what will probably be different is it will be less volatile.
All right. Before we wrap up, is there any maybe final piece of advice or message you'd like to share with our audience, Paul?
Well, my message is all about education. And I guess the best advice that I have, and it sounds self-serving, but you go to paulmerriman.com, you go to boot camp, you look at those 9 pages of articles, podcasts, and videos, but you go there and you read those 9 pages of information, or you see what's there. And then if you have questions, you sit down and you email me, paul@paulmerriman.com. I'm not a financial advisor. I'm not going to give you personal advice, but I know how to talk about the things that are in those 9 important pages. And if I can be of any help, that's why I'm here. I only have a few years I can do this. So if you want to get my help, and by the way, I'm not charging for anything. I'm only trying to help people who want to be do-it-yourselfers. That's the best advice I have.
All right, Paul. So the paulmerriman.com, is it the main resource you are offering, or maybe there are some other links you want to recommend as well?
Well, I'll tell you, there is on the home page, there's a great big box that says Bogleheads. If you click on that, it will take you to the page that I created for the Bogleheads that shows links to all of the 200 tables that we have on our site and makes it real simple to review the tables. That's it.
All right. Paul, it's been an absolute pleasure having
Thank
you
you.
on the show.
Thank you very much.
Thank you once again for your time and insights. We wish you all the best in your continued efforts to educate and
You on
empower
yours.
investors.
And
Thank
you on
you.
yours, Jack, with your
Thank
new.
you.
I hope this podcast gets in the hands of lots of folks. So
thank you, Paul.
good
Also,
luck
I
to you.
wanted to remind and invite everyone to check out also etfatlas.com because it's a brand new portal. So there's a lot of comprehensive information about ETFs from the United States, Canada, and Europe. So you're welcome to visit as well and give us the feedback. And also remember paulmerriman.com. Thank you very much.
Thank you, Jack.